What's priced into the stock market right now? Maybe it's pricing in a recession, maybe it's not. Maybe it's pricing in a period of higher inflation, higher interest rates, lower valuations as a result. Does it even matter? Hey, what's up, y'all? I am here today with my good friend and co-host for these Friday editions of the podcast. I've got Marshall Johnson here with me.
Hey, what's up, buddy?
Hey, this is our opportunity to cover a weekend reading article with you. As we do every Friday, we take those 4 articles that we drop in your inbox, trending topics in the retirement planning space. We like to highlight one of those and have a little conversation around it. Maybe you're a reader. Maybe you just want to dive in deeper. Maybe you don't want to read, you just want to listen. Well, this is your opportunity to do that here with us. And if you don't know what weekend reading is, sign up at retirewithpurpose.com and you will receive an email every single Friday. Those 4 articles, summaries, takeaways from myself, in addition to invitations to webinars, white paper giveaways, book giveaways, all kinds of great stuff there. If you're not in a position where you can hop on the internet right now, go to retirewithpurpose.com. You can also just text us the keyword WR, key letters WR at 866-482-9559. We'll send you a link to get yourself signed up. Today we're going to be covering an article on the stock market, and it is from A Wealth of Common Sense. It is titled, What's Priced into the Stock Market? So Marshall, get that crystal ball out and tell us what's priced into the market right now. Which way is it going to go next?
Yeah, I love Ben Carlson. This is his blog. He puts out really good data, and he tries to answer questions that are top of mind, right? I think a lot of times when it comes to the stock market, you hear that phrase, well, it's priced in, or we knew interest rates were going to go up, meaning it had already been reflected in stock prices. And I think there's some common sense to that when the Fed comes out and for multiple meetings in a row says we're going to raise rates, we're going to do it this much. You know, some of that is already baked in or priced in.
Well, that's what makes an efficient market, right? A market is efficient, meaning that we shouldn't be able to take advantage of mispricing because everything's always priced into the market. If there is any given information available, it's already been priced into the market, and that's what makes an efficient market.
Especially in this day and age, right? With the information overload that we've got, the data flies around the globe really quickly, gets priced in really quickly, and according to some, that's what speeds up some of our cycles that we're seeing.
Yeah, and that's what it seems like today, right? Things are just moving much faster. This article dives in a little bit deeper into how fast things are moving and what's kind of changing with the times today and what we might be seeing in the market today. But historically, it's like the market doesn't always get it right. You know, they don't always perfectly time pricing in of a recession or an economic contraction ahead of time. Sometimes the stock market just gets ahead of the economy as a whole, and they get it wrong entirely. Maybe we're not even in a recession, and it rebounds very quickly. Also, it can also fall asleep at the wheel, right? And we could be in a recession, and then 3, 6, 9 months later, it goes, oh, whoa, we should reprice this thing, right? And then you see the impact of whatever we might be experiencing in the economy. And the article kind of walks us through different instances throughout time when the market's been early or it's been a little late to the game. And I think it's always helpful for me. I love this stuff. I think it's really interesting just to see what the market's done throughout history. But I think sometimes we need this education. We need this reinforcement of what's happened historically because we'll see in the media, it's telling us one thing, or this is where the market's at, this is what it's pricing in. And the reality is, the media is wrong a lot, but the stock market is wrong a lot as well. And we need that reinforcement that, hey, you can't time this, right? You can't time this because nobody has a crystal ball and nobody gets it right every single time. The stock market doesn't even get it right every single time. And the stock market has more information than you could even imagine.
Yeah. So as Ben points out here at the start of this article, it feels like the stock market is currently pricing in a recession, right? Like a recession is imminent or it's on the horizon. But it's important to remember that the stock market does not have a perfect track record when it comes to that, Casey.
Yeah. When they walk us through starting in 2007, 2008, during the financial crisis, the S&P 500 was down just 5% from its all-time highs.
In December of 2007.
December 2007.
Right.
At which point, the economy had already been in a recession. The economy was already in recession, but the market's only down 5%. Compare that to today, is the economy in a recession or not? Well, it's to be noted yet, and we'll find out pretty soon what the reality of that is. We've got some good reinforcement data for where we might be today that we want to share in just a moment. And the reality is the market never fell more than 9% before the worst recession since the Great Depression hit, right?
During the financial crisis. And that's amazing
a little
to
late
me
to the game.
That the stock market did not hit a technical definition of a bear market until, which is a peak to trough drawdown of 20%, until July of 2008. Yeah. So we were all the way into July of 2008 before we were technically in a bear market.
Yeah. 4 months after Bear Stearns was bailed out by JP Morgan, 8 months into the recession, and we finally get to July of 2008. We finally get to a bear market.
So the point there was that the stock market didn't front run the recession very well during the financial crisis.
But sometimes it does.
Yeah, pair that with the recession in 2001, did a much better job. It was down 17% heading into the minor pullback in the economy.
Yeah, so it was a little early to the game in 2001. GDP contracted just 0.3% in 2001. So it wasn't like it wasn't that we saw a massive recession. The crash had a lot more to do with the speculation that preceded the slowdown in the economy. And I think that's important to note in both 2008 and 2001. You saw the market price in a recession at some point, right? It priced in a recession. Maybe it was a little late, maybe it was a little early, but it was pricing in something much worse. It was pricing in the unknown unknowns, right? The things that were somewhat unpredictable and some entirely unpredictable, such as what happened in 9/11, such as what happened with the real estate bubble and the tech bubble, right? We had a real estate bubble, we had a tech bubble. That's what really drew us down. It's one thing to price in a recession, but then if you're in a recession, you get hit with a black swan, then you see these big tumbles. Then you see these tumbles of 40, 50, 60%.
And so it begs the question, are we just seeing a reset of valuations, right? Did things just go up too much after we got out of COVID? Are we just resetting the price levels?
Due to inflation and interest rates, a lot like what we saw in the 80s and the 70s.
Instead of, an imminent, despair recession is kind of the argument.
Yeah, the early 80s, good example of that. It was a little slow to react to the recession. The S&P 500 was slow to react to that recession. It was down just 6% by the time the recession was underway. And
higher inflation, rising interest rates, kind of a similar backdrop to what we see today.
Yeah, the market did a much better job of front-running the end of the recession at that point. Massive pop. Massive pop prior to the recession actually ending. It got back to all-time highs before the contraction actually ended.
And I think that's a key point for everybody listening, right? The economy can still be in a recession, and the market could have already bottomed and starting to lead out. You see that in these charts in almost every one of these examples.
It's crazy. If you were to look at that chart, it's a wild chart, right? We're seeing a bottom in roughly July, August of 82, and then heck, before the end of the year, before the recession's over, the market has taken a massive rebound, almost in a straight line back to the top, and many individuals would have gotten that wrong. Many people that are trying to time the market, boy, they would have had to have it right within a couple of days to get anywhere close to that bottom and actually take advantage of it. And again, just over the long term, should we even be doing that? No, we should be thinking about rebalancing. We should be thinking about putting cash to work. We should be thinking about doing Roth conversions. But to say, oh, I'm going to go to cash and then, well, when the recession's over, I'll get back in. The market often rebounds before the recession is over. And I think, that's what we saw during, 2020 with COVID.
The market recovered long before.
I know advisory firms that moved their clients to cash in March of 2020 saying, oh, we're going to do what our clients are asking us to do, right? Everybody's calling, everybody wants us to go to cash. Let's go ahead and go to cash because this is going to be a massive recession. We're going to see another 20% down. Then we'll get in. They got it wrong. And as a result, they burned a lot of families. You cannot time these things no matter how much you know. And I know some really good advisors that got this wrong and learned a hard lesson along the way.
Yeah, you talk about some of those lessons and you try to understand, you try to learn from the past. This chart kind of goes through the 70s and talking about how sometimes the worst part of the drawdowns is actually during the recession. Sometimes it precedes the recession. That's what you mean by the timing. But, there's also some argument right now whether we're even in a recession, right? The author here quotes Bill McBride saying that the recession callers are back, like Kathy Wood, Home Depot, these folks are saying that we're there. We did see negative GDP growth in the first quarter, and we very well may see slightly negative GDP growth.
Yeah, I mean, these weren't massive numbers.
For some people, it's like, oh, there we go. 2 negative quarters makes a recession. But there's the labor piece to it.
And there's a lot of data that goes into this. It's not just 2 quarters. That's not the default that calls a recession.
Yes.
Yeah, there's a lot of data that is going to be taken into account before we actually see the news be released that we are actually in a recession. And part of that data would be jobs reports. 1.6 million jobs were added in quarter one. That's not a recessionary number. Over 800,000 jobs were added in
Q2.
The first 2 months of Q2. That's just the first 2 months of Q2. It might even be higher by now. Not a recession indicator.
Yeah. So there's some data that says, hey, we're slowing, the economy's slowing, but other data is surprisingly resilient right now. And I think that just speaks to how, as he says, bizarre the current economic environment is. And oftentimes we do have this conflicting data. But I think he goes on to say, this is my favorite part of the article. It's important to remember that the stock market doesn't need a recession to go into a bear market.
It doesn't matter, right? There's been recessions and the market's ended positive by the end of the year.
You're still down 20%, right? It doesn't matter. It shouldn't matter to you as the investor. It should matter to your planning, right? What you're doing right now. The market's down 20%. Are you building cash? Do you have liquidity? Keep investing, rebalancing, tax loss harvesting, Roth conversions. Those are the things that matter. It doesn't matter whether this is technically a recession or not. The market's down.
Yeah. I mean, look, the non-recessionary bear markets from 1928 through 2022, these are non-recessionary bear markets. Average down of 26.1% over 202 days. And there's been periods where we were down 33% outside of a recession, 20% outside of recession.
Hey, that gives me some encouragement, though. It says the average number of days was 202. I looked it up as of this recording. We're like at day 193. So, hey, we're almost there.
Yeah,
as far as the drawdown,
but we've had shorter periods in recessionary periods, and right now,
leave my cup half full.
The stock market likes to rip the Band-Aid off in both directions. That's what we saw during COVID, and right now, we might already be in a recession, and the stock market might have priced it in already. Maybe we're not in a recession, and it never comes, and we see a very quick rebound at the same time. We don't know what's going to happen, but we know what our friends are during any bear market. We are in a bear market. We can put a nail in that. We know we're in the bear market. Maybe we don't know when we're in a recession. What should you do in this environment is the things that we talk about all the time. That's liquidity, patience, a long-term horizon. I mean, all those things sound great, but that has to fall into a planning process itself. You have liquidity. You need to know how much liquidity should I have, and that's why our planning process itself, the plan that we're going to develop around our Retire with Purpose framework, is the LIFE acronym. And the number one thing that we start with every family is liquidity. Liquidity and an income strategy are the two things you really have to have in order to have patience and a long-term time horizon. If you don't have liquidity, if you don't have an income strategy, and you're just 100% invested in the market, you don't have an income strategy, you can't have patience, you can't have a long-term outlook because you go, hey, I'm in retirement, I need income from this right now. Or, hey, I'm in retirement, my roof just got ripped off by a derecho, and I need to get I need some cash out of my plan, right? I didn't have enough liquidity for that. You can't have the confidence to be patient. You can't have the confidence to think long term if you don't have liquidity to take care of emergencies and take advantage of opportunities, and an income strategy to buy you time to continue to have that long-term time horizon with a good portion of your portfolio.
Yeah, a plan like that gives you the confidence to what? When the bear is attacking, you play dead, right? That's what you're supposed to do. That thing's huffing and puffing. He's smelling you. That's really scary, right? You want to run. You want to sell everything. You want to take off, but that could kill you, right? You just got to play dead. You got to have a strong, stable plan.
Doesn't that depend on the type of bear, though?
I don't know. I was reaching a bit.
We got to be careful giving bear survival advice here.
Well, that's what they say. Play dead. But
we'll give bear market survival advice.
But bear attacks
is the wrong way.
Come on, there was an analogy there. I was going places.
Good stuff. I love it. I love it. No, I hope you found this helpful. Just understanding where the market is today, what's going on. That's what we want to provide you insight on. Assess where you're at today. Think about making some adjustments, taking advantage of some opportunities. There's always an opportunity, bear market or bull market. Don't sit idly on your hands.